Welcome to Topical Economics. If you are new here, don't forget to subscribe and hit the bell icon so you never miss any of our insightful videos on key economic concepts. In today's video, we're diving into the topic of foreign exchange rates. I'll be walking you through some past paper multiple-choice questions, carefully analyzing each one to explain why the correct answer is what it is. Whether you're preparing for exams or just want to strengthen your understanding of economics, this video will help you get to grip with important concepts in a clear and practical way. So, let's get started. Starting with the first question. What is most likely to result from a reduction in the value of a country's currency if there are no other changes in the economy? A. A trade in goods surplus will fall. B. Export prices will rise. C. Import prices will rise. D. The inflation rate will fall. Reference, 2022 May-June version 2. The correct answer for this question is option C. Import prices will rise. When the value of a currency decreases, a depreciation, it takes more of that currency to buy the same amount of foreign goods or services. As a result, the price of imports, foreign goods and services, becomes more expensive for consumers and businesses within that country. Analyzing the other options. Option A. A trade in goods surplus will fall. A currency depreciation could actually improve the trade balance, as exports become cheaper for foreign buyers and imports become more expensive for domestic consumers. This may lead to an increase in exports and a reduction in imports, potentially increasing the trade surplus. Next, option B. Export prices will rise. From the perspective of foreign buyers, export prices would generally fall because the country's goods become cheaper in foreign currency due to the depreciation. This is typically one of the reasons why exports rise when a country's currency weakens. Lastly, option D. The inflation rate will fall. A currency depreciation typically leads to higher import prices, which can contribute to higher inflation, not lower inflation. Moving to the second question. The price of a currency in a fixed exchange rate system is reduced. What is this called? A. Appreciation. B. Depreciation. C. Devaluation. D. Revaluation. Reference, 2022 May-June version 2. The correct answer for this question is option C. Devaluation. In a fixed exchange rate system, the government or central bank sets the exchange rate of the currency against another currency or a basket of currencies. If the price of the currency is reduced, that is, it is made worth less in terms of foreign currencies, this is called devaluation. Devaluation refers to a deliberate reduction in the value of a country's currency under a fixed exchange rate system, usually to address trade imbalances by making exports cheaper and imports more expensive. Analyzing the other options. Option A, appreciation, is the increase in the value of a currency, which would happen if the price of the currency were to rise. Next, option B, depreciation, refers to a decrease in the value of a currency in a floating exchange rate system, where the currency's value is determined by market forces. In a fixed system, a depreciation is typically not a term used unless referring to a fall in value due to market pressures outside of government control. Lastly, option D, revaluation, is the opposite of devaluation. It refers to the deliberate increase in the value of a currency in a fixed exchange rate system. Moving to the third question. What is the definition of foreign exchange rate? A. The difference between emigration and immigration. B. The difference between the values of imports and exports. C. The price of one currency in terms of another. D. The price of one good in terms of another. Reference, 2022 May-June version 1. The correct answer for this question is option C. The price of one currency in terms of another. The foreign exchange rate, often simply called the exchange rate, refers to the value of one currency relative to another currency. It is the price at which one currency can be exchanged for another. For example, if the exchange rate between the US dollar, USD, and the euro, is $1 equals 85 cents, this means that $1 can be exchanged for 0.85 euros. Analyzing the other options. Option A, the difference between emigration and immigration, refers to net migration, not the foreign exchange rate. Next, option B, the difference between the values of imports and exports, refers to the trade balance, not the foreign exchange rate. Lastly, option D, the price of one good in terms of another, refers to the price of goods or a relative price, but not to the concept of a foreign exchange rate. Moving to the fourth question. What is an immediate effect for a country of a fall in its foreign exchange rate? A. A fall in the money supply. B. An increase in purchasing power. C. Cheaper imports. D. More competitive exports. Reference, 2021 October-November, version 1. The correct answer for this question is option D. More competitive exports. A fall in a country's foreign exchange rate means the country's currency has depreciated, or weakened, relative to other currencies. This immediate change has the following effects. Cheaper exports. When the currency depreciates, the country's goods and services become less expensive for foreign buyers. For example, if the US dollar weakens, a US product becomes cheaper for someone paying in euros, which can boost demand for exports. This makes a country's exports more competitive in international markets. Analyzing the other options. Option A, a fall in the money supply. A fall in the exchange rate does not directly lead to a change in the money supply. A fall in the exchange rate is typically a market outcome based on factors like supply and demand for currency, not a direct result of monetary policy that would affect the money supply. Next, option B, an increase in purchasing power. A fall in the currency's exchange rate reduces purchasing power for people in the domestic country because it now costs more to buy foreign goods and services. Therefore, purchasing power actually decreases, not increases, with a weaker currency. Lastly, option C, cheaper imports. A fall in the foreign exchange rate makes imports more expensive, not cheaper, for the country whose currency has depreciated. Foreign goods cost more because the domestic currency is worth less relative to other currencies. Moving to the fifth question. What does a foreign exchange rate between Malaysia and the US measure? A. The cost of the Malaysian currency and the US currency. B. The difference in the cost of living between Malaysia and the US. C. The difference in the standard of living between Malaysia and the US. D. GDP of Malaysia divided by the GDP of the US. Reference, 2021 May-June version 3. The correct answer for this question is option A. The cost of the Malaysian currency and the US currency. The foreign exchange rate between Malaysia, e.g., the Malaysian ringgit, MYR, and the US, e.g., the US dollar, USD, measures how much of the US currency is needed to buy a unit of the Malaysian currency. In other words, it shows the price of one currency in terms of another. For example, if the exchange rate is $1 equals 4.50 MYR, this means that $1 can be exchanged for 4.50 Malaysian ringgit. Analyzing the other options. Option B, the difference in the cost of living between Malaysia and the US. The foreign exchange rate doesn't measure the cost of living. The cost of living is an economic concept related to the prices of goods and services in different countries, not the value of their currencies. Next, option C, the difference in the standard of living between Malaysia and the US. While exchange rates might have an indirect effect on the standard of living, they don't directly measure it. The standard of living is typically assessed using metrics like income, health, education, and access to services, not through the exchange rate. Lastly, option D, GDP of Malaysia divided by the GDP of the US, refers to a GDP ratio or a measure of the relative economic size between two countries, but it is not related to the exchange rate. Moving to the sixth question. A US car dealer agrees an import price of $25,000 for a Japanese car at the current rate of exchange. The US dollar then strengthens by 10% against the Japanese yen. What will be the new import price paid for the Japanese car? A. $20,000. B. $22,500. C. $25,000. D. $27,500. Reference, 2021 May-June version 1. The correct answer for this question is option B. When the US dollar strengthens by 10% against the Japanese yen, the US dollar becomes more valuable relative to the yen. This means that fewer US dollars are required to purchase the same amount of yen. In the case of the Japanese car, which was initially priced at 25,000 US dollars, the strengthening of the dollar by 10% would result in a 10% reduction in the price of the car in US dollars. To calculate this, we reduce the original price by 10%, which means the new price would be 90% of the original price. So, the new price of the car would be 25,000 times 0.90, which is equal to 22,500. Therefore, the new import price paid for the Japanese car would be 22,500 US dollars, reflecting the reduction due to the stronger US dollar. Moving to the seventh question. What is meant by a depreciation in the foreign exchange rate? A. The government intervenes to reduce the exchange rate of the country's currency. B. The rate of exchange of exports for imports for a country deteriorates. C. The rate of inflation in a country continues to rise. D. The value of a country's currency falls on the international exchange market. Reference, 2020 October-November version 1. The correct answer for this question is option D. The value of a country's currency falls on the international exchange market. A depreciation in the foreign exchange rate refers to a decline in the value of a country's currency relative to other currencies in the international exchange market. When a currency depreciates, it takes more of that currency to purchase the same amount of foreign currency. This typically happens in a floating exchange rate system, where the value of the currency is determined by market forces such as supply and demand. Analyzing the other options. Option A. The government intervenes to reduce the exchange rate of the country's currency, refers to a devaluation in a fixed exchange rate system, where the government actively reduces the currency's value. In depreciation, the market causes the decline, not government intervention. Next, option B. The rate of exchange of exports for imports for a country deteriorates. While depreciation can make exports more competitive and imports more expensive, this option is not the definition of depreciation itself. Depreciation affects the relative cost of goods and services, but it doesn't directly describe the value change of the currency. Lastly, option C. The rate of inflation in a country continues to rise. Inflation and depreciation are related, but depreciation itself does not directly describe inflation. Depreciation can lead to higher import prices, which can contribute to inflation, but they are distinct concepts. Moving to the eighth question. Many low-income countries rely on exports of raw materials such as coffee or iron ore to earn them foreign currency. What is a disadvantage of this? A. Countries have a constant demand for raw materials. B. International trade only benefits the importing countries. C. It is necessary for low-income countries to belong to a free trade area. D. Raw materials have fluctuating prices. Reference, 2020 May-June version 1. The correct answer for this question is option D. Raw materials have fluctuating prices. One of the main disadvantages of relying on the export of raw materials, such as coffee or iron ore, for foreign currency is that the prices of these commodities can be very volatile. The prices of raw materials often fluctuate due to global demand, weather conditions, political events, and other factors. This makes it difficult for low-income countries to predict their income from exports, and they may face periods of low revenue when prices drop. Such fluctuations can destabilize their economies, especially when they depend heavily on just a few types of exports. Analyzing the other options. Option A. Countries have a constant demand for raw materials, is not necessarily true. The demand for raw materials can vary over time, depending on factors like changes in global economic conditions, technological advancements, or shifts in consumer preferences. Thus, a constant demand is not guaranteed. Next, option B. International trade only benefits the importing countries, is incorrect. Both importing and exporting countries benefit from trade. Exporting countries earn foreign currency, which they can use to import goods, invest, or improve their economies. The idea that trade only benefits the importing countries is a misconception. Lastly, option C. It is necessary for low-income countries to belong to a free trade area, while being part of a free trade area can provide benefits like lower tariffs and expanded market access. It is not a direct disadvantage of relying on raw material exports. The issue here is the volatility of raw material prices, not the trade arrangements. Moving to the 9th question. There has been an appreciation of the value of a country's currency against other currencies. What effects will this have on prices of imports of raw materials and prices of exports of manufactured goods? Reference, 2020 May-June version 2. The correct answer for this question is option B. When a country's currency appreciates, that is, it increases in value against other currencies, it means that the domestic currency is stronger. As a result, imports of raw materials become cheaper. The stronger currency means that it takes fewer units of the domestic currency to buy foreign goods and services, including raw materials. As a result, the price of imported raw materials decreases because the country's currency is now worth more relative to the foreign currency, making imports more affordable. And exports of manufactured goods become more expensive. When the domestic currency appreciates, the country's goods and services become more expensive for foreign buyers. This is because, in foreign currency terms, the products now cost more. For example, if a country's currency appreciates against the US dollar, foreign buyers will need more of their own currency to buy the same amount of the country's manufactured goods. As a result, the price of exports increases, which may reduce the competitiveness of those goods in international markets. Moving to the 10th question. What would increase the demand for a country's currency on the foreign exchange market? A. A decrease in its inward investment. B. A decrease in its rate of interest. C. An increase in its exports. D. An increase in its imports. Reference, 2020 February-March version 2. The correct answer for this question is option C. An increase in its exports. An increase in a country's exports leads to higher demand for its currency on the foreign exchange market. When foreign buyers purchase goods or services from a country, they need to convert their own currency into the currency of the exporting country in order to complete the transaction. As a result, the demand for the exporting country's currency rises. Analyzing the other options. Option A. A decrease in its inward investment, foreign direct investment or portfolio investment, would actually reduce the demand for the country's currency. When foreign investors invest less in a country, there is less need for that country's currency. Next, option B. A decrease in its rate of interest, would typically reduce demand for its currency. Lower interest rates make the country less attractive for foreign investment, which in turn reduces the demand for its currency. Lastly, option D. An increase in its imports, would reduce the demand for the country's currency. When a country imports goods, it needs to exchange its currency for the currency of the exporting country. This results in higher demand for foreign currencies and lower demand for the domestic currency. Moving to the 11th question. What is the most accurate definition of a foreign exchange rate? A. A rate at which exports are exchanged for imports. B. A rate determined by the demand and supply of the currency. C. A value of a currency as fixed by the government. D. A value of a currency expressed in terms of another currency. Reference, 2019 May-June version 1. The correct answer for this question is option D. A value of a currency expressed in terms of another currency. The foreign exchange rate refers to the price at which one currency can be exchanged for another. It tells you how much of one currency is required to buy a unit of another currency. For example, if the exchange rate between the US dollar, USD, and the euro, is $1 equals 85 cents, this means $1 can be exchanged for 0.85 euros. Analyzing the other options. Option A. A rate at which exports are exchanged for imports, is a concept related to trade balances or terms of trade, not the definition of a foreign exchange rate. The exchange rate doesn't directly determine how exports and imports are traded, it just determines the value of currencies in international transactions. Next, option B, a rate determined by the demand and supply of the currency. While the foreign exchange rate can be influenced by the demand and supply of a currency, especially in a floating exchange rate system, this description is not the most accurate or complete definition of the foreign exchange rate itself. The exchange rate is the value of one currency relative to another, regardless of how it is determined. Lastly, option C, a value of a currency as fixed by the government, would describe a fixed exchange rate system, where the government sets the exchange rate. However, in most cases, especially under floating exchange rate systems, the exchange rate is not fixed by the government but determined by market forces. Moving to the 12th question. The world demand for oil is price inelastic and oil is paid for in US dollars. If the price of oil falls rapidly, how might it affect the exchange rate of the US dollar? Reference, 2019 May-June version 2. The correct answer for this question is option C. If the price of oil falls rapidly, it is likely to lead to a decrease in the demand for the US dollar. This is because oil is traded globally in US dollars, and when oil prices drop, oil exporting countries, which earn US dollars from their oil exports, will see a reduction in their dollar revenues. As a result, these countries will have less need to hold US dollars and may exchange them for their own currencies. Additionally, countries that import oil will need fewer dollars to pay for oil, further reducing demand for the US dollar. This reduction in demand, combined with a potential increase in the supply of dollars, as oil exporting countries convert dollars into their local currencies, will likely lead to a fall in the value of the US dollar on the foreign exchange market. Move to the 13th question. Changes in the foreign exchange rate of a country resulted in a depreciation of its currency. What is not likely to happen? A. The costs of imported raw materials will fall. B. The country's export trading position will become more competitive. C. The country's residents will find it more expensive to take holidays abroad. D. The current account deficit will be unchanged. Reference, 2019 May-June version 3. The correct answer for this question is option A. The costs of imported raw materials will fall. When a country's currency depreciates, falls in value relative to other currencies, it means that it takes more of the local currency to buy the same amount of foreign currency. This typically increases the cost of imports, including raw materials, because the country now needs more of its own currency to purchase the same amount of foreign goods or services. Therefore, the cost of imported raw materials would rise, not fall, in the event of a depreciation. Analyzing the other options. Option B. The country's export trading position will become more competitive. When the currency depreciates, the country's goods and services become cheaper for foreign buyers, making exports more competitive. This is a common effect of depreciation, as it boosts demand for cheaper, locally produced goods in international markets. Next, option C. The country's residents will find it more expensive to take holidays abroad. A depreciated currency means that residents will need more of their local currency to purchase foreign currency, making foreign travel more expensive. This is another typical consequence of currency depreciation. Lastly, option D. The current account deficit will be unchanged, is unlikely, as a depreciation typically affects a country's current account balance. A weaker currency can improve the trade balance, exports become cheaper and imports become more expensive, which often helps reduce a current account deficit. However, the actual outcome depends on the price elasticity of demand for exports and imports, so it may not always be the case. Still, it's generally more likely that the current account deficit would improve, not remain unchanged, following a depreciation. Moving to the 14th question. What usually decreases when there is a depreciation of a country's foreign exchange rate? A. The level of national debt. B. The level of trade protection. C. The price of exports. D. The price of imports. Reference, 2019 February-March version 2. The correct answer for this question is option C. The price of exports. When a country's currency depreciates, it becomes weaker relative to other currencies. As a result, goods and services produced in that country become cheaper for foreign buyers because it takes less foreign currency to purchase the same amount of domestic goods. This increase in price competitiveness typically leads to an increase in exports, not a decrease. The key point here is that depreciation of the domestic currency makes exports less expensive for foreigners, which can help boost the country's export sector. Analyzing the other options. Option A, the level of national debt. A depreciation in the currency does not directly lead to a decrease in national debt. In fact, if a country has debt denominated in foreign currencies, depreciation can increase the cost of repaying that debt in local currency terms. As a result, the level of national debt could actually rise, especially if the debt is foreign currency denominated, rather than decrease. Next, option B, the level of trade protection, such as tariffs and quotas, is a matter of government policy and does not directly change as a result of a currency depreciation. While a depreciation can affect trade balances and the competitiveness of domestic goods, it does not automatically lead to changes in trade protection measures. Trade protection is influenced by political and economic factors, not by exchange rate fluctuations alone. Lastly, option D, the price of imports. A depreciation of the domestic currency causes import prices to rise, not fall. This is because it takes more of the domestic currency to purchase foreign goods or services. So, while the depreciation may make exports cheaper, it makes imports more expensive for domestic consumers and businesses. Therefore, the price of imports increases when a currency depreciates, which is the opposite of what is asked in the question. Move to the 15th question. The Mexican currency, the peso, has fallen in value against the US dollar. What will be the effect of this on the Mexican economy? A. A decrease in tariffs on imports. B. A decrease in the price of exports. C. A decrease in the price of imports. D. A decrease in the volume of exports. Reference, 2018 May-June version 1. The correct answer for this question is option B, a decrease in the price of exports. When the Mexican peso depreciates, falls in value, against the US dollar, it means that the peso is weaker compared to the dollar. This has several effects on the economy, especially in terms of trade. A weaker peso makes Mexican goods and services cheaper for foreign buyers, including those in the United States, because they need fewer US dollars to purchase the same amount of Mexican products. As a result, the price of exports decreases for foreign buyers, which can make Mexican exports more competitive in international markets. This often leads to an increase in the volume of exports, not a decrease. Analyzing the other options. Option A, a decrease in tariffs on imports. Tariffs are government-imposed taxes on imports, and they are not directly related to the exchange rate. A depreciation of the peso does not automatically lead to a decrease in tariffs. In fact, the government could increase tariffs to protect domestic industries from the rising cost of imports. Next, option C, a decrease in the price of imports. A depreciation of the peso makes imports more expensive, not cheaper, because it takes more pesos to purchase the same amount of foreign goods or services. The cost of imports increases for Mexican consumers and businesses, which is the opposite of what is suggested in this option. Lastly, option D, a decrease in the volume of exports. A depreciation typically increases the volume of exports, not decreases it, because the weakened currency makes the country's goods cheaper for foreign buyers. As Mexican products become more affordable in foreign markets, demand for exports generally rises. Thank you for watching this video. I hope the explanations of past paper questions and the reasoning behind the correct answers helped clarify some key concepts. If you found this video useful, please don't forget to like, comment, and subscribe to Topical Economics for more insightful lessons and exam tips. Your support is truly appreciated, and it encourages me to keep creating valuable content to help you succeed. Feel free to leave any questions in the comments, and I'll be happy to assist. Thanks again for being a part of the Topical Economics community.